The individual pension plan is a retirement pension that is set up for one individual, either an employee in an existing defined benefit pension or an incorporated professional, including business owners. The I.P.P. transfers the capital, creditor protected, from your existing defined benefit plan into your I.P.P. You quit work, set up a professional corporation, and continue to work on contract. You make the investment choices. You draw from your I.P.P. pension when you retire, and, importantly, the remaining assets go to your spouse and heirs when you die.
Hi, I'm John Chevreau, financial columnist, and I'm here today talking to Bruce Youngblud, certified financial planner and Canadian investment manager. And we're talking about the individual pension plan, or I.P.P. So Bruce, tell us exactly what an I.P.P. is.
John, an individual pension plan is a Canada Revenue Agency approved pension, normally set up for one individual. There are two groups likely to set up the I.P.P. One is a person in a defined benefit pension at work, and we'll start by discussing that scenario. The other is the incorporated professional or business owner. We'll discuss that second scenario later in this interview.
Okay, so let's drill down. Tell us more about the I.P.P. and perhaps you could give us an example.
Okay, just as an employee with a pension plan at his or her place of work can look forward to an income for life from the company pension plan, the I.P.P. pays you an income for life. Either you transfer the capital from your company pension, or as a business owner you set that up in your own company. The main benefit is that you move the capital into your own I.P.P. The money is now part of your asset base. It provides you with a pension plan and stays in your estate when you die. For example, let's say you worked for company XYZ for 30 years. You wish to retire someday. The commuted value of your existing pension stands at about $750,000. You move that money to your I.P.P. with no tax on transfer. The funds remain creditor protected. You become an employee of your corporation. Very importantly, you continue to work at your profession. When you retire, you draw a pension. Any money remaining on your death goes to your spouse, your children, or other beneficiaries.
Bruce, when should an employee consider moving capital out of their pension plan and into an I.P.P.?
You will want to set up an I.P.P. as you approach retirement. Don't wait until you have retired, as the I.P.P. requires that you continue to work for a few years after the setup.
So Bruce, why is now the best time to make this transfer?
Good question, John. The time is now because interest rates are low. The calculation of a pension plan's commuted value generally results in higher amounts when interest rates are low. Pension plans must pay out more capital to fund the projected income. Note that if the situation is appropriate, the transfer of funds to the I.P.P. will not be taxable. The transfer of money between pension plans can be done as a tax-free rollover, the same as when an employee goes to work for a new company and his or her pension follows. Anytime assets are transferred out of a pension plan, the actuarial calculation considers current interest rates. As you know, interest rates are at all-time lows. This translates into higher payout amounts from guaranteed pension plans. The best time is now. As interest rates move higher, payout amounts will decline.
So Bruce, I guess not, an I.P.P. doesn't sound like it's for everybody, but there are certain groups that it is ideally suited for.
Yeah, good point. In my experience, there are four primary candidates for the I.P.P. First, those who simply wish to move the assets of a pension plan into a defined benefit plan more under their own control. Secondly, if you're single with kids and you just quote-unquote take the pension at work, that income normally stops when you die. Instead, move the capital to the I.P.P. so that the capital becomes part of the family asset. Thirdly, if your health is not good, or your family health history is weak, you should consider moving the capital to the I.P.P. That way when you die, the money stays quote-unquote in the family and goes to your spouse or kids or other beneficiaries of your choice. And lastly, if you're approaching retirement and still have high debt, it may be possible to unlock some of the capital to pay down debt.
So it's really an estate planning tool.
Yes, exactly.
So what conditions apply to moving your money out of your pension plan and into an I.P.P.?
The principal condition, John, is that you continue to work. This will likely be as an employee of your own corporation. Canada Revenue Agency expects you to keep working for a few years before you start to draw your I.P.P. pension.
So Bruce, maybe you can give us an example.
Harry works for a major corporation. He has worked there for 25 years, he's married, has 3 adult children. Harry's decided to continue to work for a few more years yet. He's faced with a choice. Simply work as his dad did, then draw a pension on retirement. Alternatively, Harry can set up the I.P.P. now and continue to work as a consultant through his own corporation. So, he leaves his employer, then sets up an incorporated consulting firm and continues to work at a similar income level. When he does retire in a few years, Harry will draw his pension the same way that his co-workers do. On his eventual death, his wife continues to draw money from the I.P.P. After her death, the residual forms a major part of their estate for the kids.
Bruce, you mentioned that there was a second group of people who can really benefit from I.P.Ps, incorporated professionals and family-owned businesses.
Okay, one of the advantages of I.P.Ps within a family-owned business is the ability to transfer the pension assets to the next generation at the death of the parents, tax-free. All contributions to the I.P. are fully tax deductible to the corporation. The I.P.P. allows the owner to separate retirement assets from assets of the corporation. There are potentially higher contribution limits than for RRSPs. Funds in the I.P.P. are creditor protected. Upon setup, you may be able to go back and claim past service. You gain the ability at retirement to enhance your pension, which essentially draws more money from the corporation on a tax-free basis. Make additional contributions on a voluntary basis, thereby taking advantage of consolidating other registered assets for more efficient investing. The key remains to transfer assets from the corp to the I.P.P. The I.P.P. could also work for a key employee. Unlike the RSP, your corporation can transfer funds to top up your pension plan in the event of a market downturn. The solution should be considered by doctors and dentists and other incorporated professionals. The I.P.P. can offer you further creditor protection as these assets are moved out of the operating corporation.
So Bruce, if I understand it correctly, the I.P.P. is a lot more flexible than your traditional corporate defined benefit pension plan, even though the flexibility was perhaps diminished a little bit by the recent federal budget.
Correct. Let me answer that this way. Once you finish working, you have the option of moving your I.P.P. into a lira. This may not be a completely tax-free transfer, as the Income Tax Act limits the amount that can be transferred tax-free. A portion may be taxable. However, you will also end up with a high percentage of non-locked-in money, hence the flexibility. For example, if you have $1.4 million in your I.P.P., which is not unusual, you move all that to a lira. Roughly $1 million is sheltered by your lira. The balance of the money comes out as taxable income in the calendar year. Now, each situation is different. This is just an estimate. Of the $1 million in the lira, 50% can be unlocked and moved into a regular RSP on a non-taxable transfer. It will still be taxable on drawing, but the point is it's now in a non-locked-in RRSP. Then the locked-in money, per the budget, you must start paying out as a pension.
So Bruce, if I were to summarize all this for the average person, an I.P.P. is basically a super RRSP for business owners.
Yeah, that's a great summary. The I.P.P. is a pension plan normally set up for one individual. The key reason to set this up is the transfer of company pension assets to your personal I.P.P. The assets remain creditor-proof. When you die, the assets are part of your estate. The time is now when interest rates are low, so payouts are high. Thanks for watching. You can contact us at individualpensionplan.tv. Call my office at 905-648-9933 or email me, Bruce at individualpensionplan.tv. Thank you. Thanks, John.
Thank you, Bruce.